Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Hedge Funds Explained, how they work and why they matter in 2024. Risks and challenges of hedge funds. Hedge funds are known for their high return potential, but they don't come without risks and challenges. As an investor, it's crucial to grasp these factors and understand how they can influence your investment. Let's break down some key areas of concern. Market risks. Hedge funds are like surfers riding the economic waves. They can ride high on big swells when markets are booming, but they can also wipe out during turbulent times. Here's how. Volatility. Markets can be unpredictable. One day they might be calm like a placid lake, and the next they're crashing like a stormy sea. Hedge funds often use complex strategies that can amplify these swings, which means potential gains can be just as significant as potential losses. Economic changes. Think of hedge funds as adventurers in a constantly shifting landscape. Economic indicators such as interest rates, inflation, and global events can change the terrain, making it difficult to predict outcomes. Hedge funds might need to adjust strategies quickly, but sometimes even the best prepared funds can be caught off guard. Market risk isn't something that can be fully avoided, but understanding it can better prepare you for the ups and downs. Liquidity risks. When it comes to liquidity, hedge funds can be like a roller coaster ride where you can't just hop on and off whenever you want. Liquidity risk involves challenges that might keep investors locked into their positions for longer than expected. Redemption restrictions. Many hedge funds have rules about when you can take your money out. It's like entering a contract that says you're on board for a certain duration. If you're thinking about investing, be prepared to wait, sometimes for months or even years, before you can cash out. Market liquidity. Not all assets can be sold quickly. Imagine owning a rare painting. It's valuable, but selling it might take time. Similarly, some hedge fund investments might not be readily convertible to cash, especially during market downturns. Understanding these liquidity issues helps set realistic expectations about accessing your investment. It's important to assess if these timelines align with your financial goals. Considering these risks, when navigating the world of hedge funds, equip yourself with knowledge to determine if it aligns with your risk tolerance and financial plans. Understanding these challenges can guide you to make informed decisions about your investments. Performance metrics of hedge funds. Let's take a closer look at the performance metrics that show just how well hedge funds are doing. It's like checking the report card of these investment vehicles. These metrics help investors understand not only how much money a hedge fund is making but also how well it's managing risk. Alpha and beta. When it comes to hedge funds, alpha and beta are like two sides of a coin. Alpha measures how much a hedge fund returns above a benchmark like a stock market index. It's like a scoreboard showing how well the managers are doing their job. A positive alpha means the fund is doing better than the market, while a negative one suggests it's lagging behind. On the flip side, beta checks how much the fund's returns move in relation to the market. For example, a beta of 1 means the fund's returns mimic the market's moves. A beta higher than 1 illustrates more volatility compared to the market, while less than 1 indicates less volatility. Understanding beta helps investors gauge the potential roller coaster ride they might experience with their investment. Sharpe ratio and other metrics. These aren't the only metrics in the toolbox. The Sharpe ratio is a big player when it comes to understanding risk-adjusted returns. Imagine it as a measure of how much return you're getting for every unit of risk taken. A higher Sharpe ratio means the fund is doing well compared to the risks it's taking. Besides the Sharpe ratio, several other metrics help paint the full picture. Sortino ratio. Similar to Sharpe but focuses only on downside risk. It's like concentrating on the rainy days instead of all weather patterns. Trainer ratio. This measures returns in relation to market risk, offering insights into how much risk is tied to the market instead of the individual fund. It's like distinguishing between the effects of a stormy market versus the fund's own strategy. Maximum drawdown. Indicates the worst loss from a peak to a trough. It's a reality check reminding investors about the worst-case scenario they could face. Having these metrics is akin to having a compass in the financial ocean. They guide investors in assessing whether a hedge fund's returns justify the risks taken. Simply put, understanding these numbers is crucial before you decide where to park your money. The future of hedge funds. As we look toward the future of hedge funds, it's clear that the landscape is evolving in fascinating ways. Hedge funds have always been about finding new strategies to gain an edge in the market, and the future promises even more exciting possibilities. From technological breakthroughs to shifts in regulation, let's explore how these factors could shape tomorrow's hedge funds. Technological innovations. Technology is shaking up the hedge fund industry in ways we've never seen before. It's like giving fund managers a new set of tools to dig deeper and think smarter. Automation and algorithms are making it possible to analyze massive datasets in the blink of an eye. Imagine the insights that could come from spotting patterns invisible to the naked eye. But it's not just about collecting more data. Machine learning is teaching computers to make predictions based on past trends. This means that investment strategies can be more finely tuned to adapt to changing markets. Imagine a chess game where the pieces learn from every move and adjust their strategy accordingly. That's the potential of machine learning in hedge funds. There's also the rise of blockchain technology, promising greater transparency and security in transactions. Blockchain can streamline operations and reduce costs, offering benefits that could make hedge funds more efficient and trustworthy. As these tools become more accessible, we'll likely see hedge funds taking bolder steps in their strategies. Regulatory changes. Regulatory changes are like the referees of the financial world, ensuring that everyone plays fair. In the coming years, we might see regulations tightening to adapt to new financial instruments and practices. This could mean more robust reporting requirements or restrictions on certain types of trading. How will hedge funds adapt? For some, it might mean rethinking investment strategies to ensure compliance while still aiming for high returns. Others might focus on boosting their risk management systems to stay ahead of any potential legal pitfalls. Moreover, there's the possibility of new regulations opening doors rather than closing them. For instance, some countries might relax rules on cryptocurrency trading, offering hedge funds new avenues to explore. These changes will require funds to be more agile, responding quickly to shifts in the regulatory environment like a surfer riding ever-changing waves. In conclusion, the future of hedge funds looks set to be shaped by rapid technological advancements and the ongoing evolution of regulatory frameworks. As these factors continue to develop, hedge funds must adapt and innovate to thrive in this dynamic and complex environment. Conclusion. Understanding hedge funds unveils their unique role in the investment landscape. They offer a dynamic alternative for investors seeking to diversify portfolios and potentially boost returns. Yet, it's crucial to remain mindful of the associated risks and complexities. For those intrigued by this investment avenue, further exploration and professional advice are recommended before diving in. Consider how hedge funds fit within your broader financial strategy. Are hedge funds a part of your investment strategy? Share your perspective, and stay tuned for more insights into modern investing. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.